Good day, my name is Alphinity. I'm the Client Portfolio Manager at Alphinity Investment Management. Today I have Andrew Martin with me. He's one of our co-founders and a portfolio manager in the domestic team. And of course, also the financials analyst. So welcome, Andrew.
Thank you.
So we recently received the bank results, and it's really been amid a lot of volatility. It's the Iran war, it's interest rate hikes, it's now the federal budget. Taking all of that into account, what did you make of those results?
Yeah, if we maybe just step back from all that noise for a bit, I mean, the actual results themselves. So there was a quarterly update by CDA, and there was half results from the other banks. On average, they were a bit weaker, which is the main thing. There is the contrast to the updates we saw in February, which were all a bit stronger. And so I think that taken on top of everything else that's happening, they've been taken reasonably poorly. Now, if you look at the results themselves, it was a little bit weaker. There wasn't anything big. It was a little bit here and there, largely weaker revenues. So, and in that net interest margins were a bit weaker. Some of that's timing around when rates come through. Some of it's competition. Some of it's the New Zealand dollar was affecting revenues as well. So, a little bit weaker. Probably the biggest story, though, was actually started before the results. We saw a couple of pre-announcements about provisioning top-up and concerns about credit and credit quality, etc. That would really dominated the narrative.
So if we drill down a little bit on that, and it really has been the key topic after that, is that sort of increase in provisioning with interest rate hikes and everything else that's on the go. What do you make of that? Why do you think banks had to do that?
Yeah, so there's a couple of things to think about there. So firstly, we see the actual results themselves. There's nothing really in credit quality, anything suggesting that things are deteriorating in any material way. In fact, in many cases, things were as good, if not better, than before, and things have been incredibly benign in this country. So it's less about what's happened in the past, it's more about what might happen in the future. And just given the Iran war and the flow-on effects to inflation, interest rates, etc., and then oil and what's happening with the demand for oil, or at least the supply of oil, the concern that may flow onto certain industries, certain people, and that they then may flow onto the inability of some pockets in the market to be able to repay loans. This is all ifs and ifs, and in the future. But as banks like to say, never waste a crisis, and so they've tried to be conservative and say this is an opportunity to actually top up our reserves in case something happens. Some banks are more negative than others, so it is about being conservative now for something that may happen rather than something that's actually happening now. And so I think that's a good thing. It's a good thing for a bank to be conservative. But what we need to do is just actually watch now what happens in the economy about whether or not actual credit quality issues do emerge anywhere. And of course, the longer that situation goes on with oil and inflation, the more chance something will happen. But certainly, the market has taken that negatively, because these are big numbers. These are hundreds of millions of dollars top-ups. And I think the implication is, well, if banks are doing this, they must be concerned about something. And things have been so good in the past. Even a small change to that is the negative impact, because what it has done is it's led to now earnings downgrades. So banks, if you think for the last 2 years, it's had 2 years of earnings upgrades. A lot of it's about releasing those provisions. Now they're taking provisions back onto the balance sheet. That's leading to earnings downgrades, and that is a change from what we've seen in the last couple of years.
So just that sort of tilt towards a bit more of a cautious tone and aligning a bit more with what we're hearing from the Reserve Bank.
That's right.
So if we pivot and we just talk around the budget a bit, it's really, I think the main focus has been around CGT and negative gearing and what they've done there. What is your take on what would all of that mean for the Australian banks?
So it's still early days, so we're all trying to work it out. But what I would say is the changes to negative gearing, changes to CGT, is designed to have an impact on the housing market. It's designed to have an impact on the investor part of the market and potentially lower prices and make it more affordable housing's been a big positive driver for banks for decades and decades, and so anything that negatively impacts that, by implication, flows through to potential negative impact on banks. Now we need to put it in context. It's one part of their business, if you like, and that and these may, to a certain extent, slow the growth in that part of the business. So again, we need to watch this closely, but you would think it's going to have some impact. So just put it in context. Investor mortgage lending makes up about between 30 and 40% of the flow of new mortgages to banks. So it's a big portion of what they do. And so any slowdown in that flows through the slowdown in mortgage growth, it flows through to potentially slower bank earnings growth. Again, this isn't a credit issue, this is a volume issue, so we need to put it in context. But again, something that has now changed from the last few years where we've seen constant improvement in growth in volumes, both business and mortgages, to now something potentially a bit more of a headwind, which we didn't have before.
Yes.
You lay on top of that concerns about the economy, the war, inflation, interest rates, what we've spoken about with provisioning. It's just another thing for investors to think about and say, well, actually, these banks have done very well over the last few years. Now there's a few more negatives and potentially some downgrades coming, even if they're not huge. It is a change in narrative, and therefore it makes it much tougher for banks. Now, there's a reasonable chance that we see downgrades across the whole market. We're really seeing that outside of resources. So it becomes a bit of a relative call. But on the face of it, banks are geared investments into the economy. If the economy slows, then so do banks. So that makes us a bit more cautious in the near term, just while we wait and see.
Okay, definitely sticking with the cautious tone for now. So thank you, Andrew, and thanks for listening. For more information from Andrew and the team, please visit us on alphinity.com.au. Thank you.